Gold is ripping and gold miners are going parabolic up 125% year to date. Is this turning into another 2011 style bubble, or are we just in the middle innings of this massive bull run? More importantly, is there something you should be doing about it today? Let's dive into this. All right, here's a chart of gold futures. Just been an absolute rip. Today down $30, but that's after an extraordinary $100+ advance in just a couple of days. That's very typical to see this type of a pullback. Now, look, we have all our gold measured moves. We talked about in our macro looks that we post here on YouTube all the time. The measured moves are up to 4,000 plus on the upside. So there is, at least on this impulse, a little bit more for gold to go. So I'm not ready to be calling anything imminent in terms of a turn just yet. But this has been an extraordinary run. Take the gold miners, which year to date since the start of the year, like I was saying earlier, are up 125% in this extraordinary run on the upside. Now, this is not a magic asset that doesn't correct. One of the key things we do at Big Picture Trading talk about the ebbs and flow movement of markets, where like lungs breathing in and out, you're going to have a big inhale on and push on the upside and an exhale where the markets pull back. Inevitably, we're going to get one of these. But there's a bigger question to ask. I want to quickly just go back on gold and even let's say take silver as a great example. I'm going to go back here on a weekly chart and just go back and take a look at this bubble of 2010 and 2011. And what I want to highlight is we had this ridiculous rip to the upside driven by huge money printing in the post FOMC crisis, sorry, the post great financial crisis. And since then, there was a big blow off, and they spent years, in fact, an entire decade in a bear market before this recent bull run really has begun. And so the question is, are we in the same type of bubble? Are we in a bubble where this is all about to end? Well, there's a few things that were going on in 2009 to 2011 that are very different today. So back in going to that backdrop, and we saw gold go from 700 to $1,900 an ounce. Oil prices were still relatively high on a relative basis there, which is a huge input in terms of assessing the costs that many of these miners are incurring for extracting the gold. But there was a very interesting characteristic, which was that there was an exploration boom going on. Mining companies were just putting any shovel into the ground, saying that there's a chance of gold, and these juniors would instantly have ridiculous amounts of capital thrown at them. The junior gold mining space was just one of the hottest places to be. You had crazy M&A activity. There was these large producers flushing huge amounts of cash, and all sorts of investors willing to throw money at them, being pressured to replace their depleting assets by overpaying hugely for these big acquisitions that later on had to these billion-dollar write-offs that they had to go through. There was these big capex explosions, mega projects being green lighted, all sorts of crazy things happening, and there was genuinely a frenzy to be a part of this gold story back then. Today, while gold and gold miners are on a percentage basis feeling very similar, there really lacks that kind of interest. You're not seeing any of those types of that activity that is typically there in these commodity boom bust cycles. And therefore, at least on that metric, you have to believe that there is room in the much bigger picture for this gold and gold miners to run. But that doesn't mean there aren't going to be corrections on the way. As an example, I reference NVIDIA. Go back a few years ago when NVIDIA had its extraordinary rip to the upside, where it was going 5x and so on the upside. It followed a period where twice in within a year and a half, it had 36% and a 40% correction in its price, yet it still broke the 52-week highs and rallied. What's the point I'm trying to make? It's that all these things will inevitably correct. And there is going to be a period where here gold and gold miners are going to pause and take a break. But it probably isn't the bubble peak. And while we will end up going through some corrections that may try to shake out the weak hands that are over levered up and overweight the space and force them to flatten some of their positions, I think we're still a ways away from the bull market being over, especially in the backdrop of the macro environment, which we're seeing huge geopolitical reshaping of the world, and gold being such an important reserve asset in this new paradigm. And so, the idea that it's all over is incredibly speculative. With that said, there are going to be pullbacks, and there's going to be pullbacks that will be violent enough to scare some people. So the two things are this. Obviously, I just talked about gold potentially still going to 4,000. There's an urge for many investors to jump in and just have some skin in the game to try clip some more on the upside. If you are a trader A that's already long gold and starting to get worried, or two, you're an investor that has not owned enough gold and you want to throw some skin in the game and participate in this super hot move. Well, speaking to the speculator that is not in gold and well, at least not enough, and wants some skin in the game for a short term advance, accept no substitute for a bull call spread. A bull call, and especially the option skews on the right tail of gold tend to be pretty good, which makes many bull call spreads very reasonable in terms of the payoff profile that they offer you. It gives you a very risk managed way to continue to participate on the upside of gold, and at the same time, have the ability to not have a huge amount of capital outlaid. So if there was a correction, you actually then can push in more aggressively with outright buying shares and other or the bullion. Now, for those of you in gold, as an example, you can. I'm going to just use the GLD. You can open a skewed collar, which is we can basically buy, for instance, a protective put on the GLD 5% below the market, and sell covered calls 10% above the market. And this can be basically done for 60 cents, which is like 17 basis points or 0.17% cost. Just a very, very small minimal cost to have this kind of a skewed collar where you have 10% upside, which is gold surging above 4,000 on the upside before the call runs in trouble. And by the way, this is an October expiration, so we're not going out any long period of time. And at the same time, it puts a floor under your gold, which basically means that if some sort of a short term correction begun, you wouldn't be easily shaken out of your trade, which is a very important anchor from a psychological perspective. When we start seeing little pullbacks, a lot of investors, especially those that are highly leveraged, start to get a little bit nervous. And so this is 100% the way that one could approach this. Overall, it is if you want to get in and participate on this pure momentum, bull call spreads. And if you're long a shitload of this stuff and worried about a correction, there's a great ways to build collar strategies around there to reduce the overall volatility of your position and allow you to have the staying power to hold through inevitable corrections in what I still think is the mid game of a bigger bull market. So that's the kind of stuff we do at Big Picture Trading. If you like this kind of stuff, you can always try a free trial to our website at Big Picture Trading. It's in the link below. Otherwise, have a great trading day, everyone.